Hello, ladies and gentlemen. Welcome back. This is Christopher Aaron. It is May 8th, 2020. We will have a proper gold price update. And I should just tell you very briefly, Klaus the Superdog is doing well, and we will have some time in the woods over the next couple of weeks. We had some time apart. I was traveling quite a bit, and now we are back. And frankly, there's not that much else to do during our free time than to take walks in the woods. So we will do that over the next few weeks. But for the time being, let us look at the gold price action in the most clear way possible, which is, let's have a pop quiz. It's either A, to list a bunch of fundamentals, which may be true, or maybe they are not true. B, to get very emotional and say gold's going to $10,000 per ounce tomorrow. Or C, to study the actual price action. We will do option C. So here we are looking at the gold price over the last 3 days. Now, I will tell you, just from the short-term view, the 1740 region is quite significant. And we will see this in a moment when we look at the longer-term charts. But if gold can break above 1740, it has a clear shot. Very quick move, should happen to about 1800. And so what I want to do is have a rather brief update here just to show you guys the big picture, to remind you what is happening here when we study price and price alone. And so we are looking at, for example, the value in studying price. Go back all the way to 2001 and notice how the beginning of this trend channel formed. And mind you, this included the spike on September 11th, the biggest terrorist attack in the history of modern United States, right? That fits within a trend channel even. And then we had the NASDAQ bubble deflating in here. We had the run-up in oil prices, Hurricane Katrina, all these things happening corresponding with a channel, a price channel. So we could talk about all those fundamentals, yet price still behaved in a very orderly channel here. And then when we had the breakout above that channel, notice that those former sellers then acted as buyers every time we came back to the upper boundary of that channel, including in a once-in-a-decade crash, the crash of 2008. Those buyers stepped in on that former line. Very interesting. They stepped in there in 2015 as well, and 2018 as well. So the markets are not random. Here at iGold, we flat out reject the random walk theory. Those proponents of that theory that say markets are entirely random, we say you're wrong. They're not random. There are trends that we can observe. We will not get every single data point correct. We will not get every trend correct. But studying the trends as they're visibly seen, there is value in that. And so I want to bring you back to where we are at the present. What's interesting here is that you will see as we're climbing our way up toward this 1800 level, this rise here from the low in 2018 is taking on an interesting little twist here. Take a look at this pattern that's forming here. Let me draw in the boundaries of the pattern. All we are looking at is where are gold buyers stepping in? That's the lows of the blue primary trend. Where are they stepping in? And where are sellers emerging? That's the upper line. They could be doing that for 8 million reasons. Ultimately, it's a fool's game to try to pinpoint every single reason because all the reasons are built in here to the price. And we can see that sellers are showing up at higher and higher intervals. Now, this is getting to be a fairly steep rising trend that we're seeing, right? And what I want to draw your attention to, though, is as we're hugging this resistance zone, the upper boundary, let's just not forget about this lower boundary in the gold price of this trend that began in 2018. This trend here was respected 1, 2, 3, 4 times. And I'm going to argue we should not forget about this. We should keep our sights on this for something of a retracement that may be setting up later this year. I'll take a moment to say at the end of this video, I'm going to talk about this. There is a major new signal that has appeared in the Dow to gold ratio. I usually refer to the S&P 500 when I'm talking about the stock market because the S&P 500 is more broad than the Dow. The Dow is only 30 stocks, but the S&P 500 is 500 stocks, the 500 largest companies in the United States. The United States being the largest stock market in the world. So fairly important 500 companies. But when I'm talking about the Dow to gold ratio, we have data that goes back further than the S&P 500 to gold ratio. We have data going back to the late 1800s. And there has been a signal that has only appeared for the second time in the history of this ratio that has just been registered over the last month. I've spent the last week analyzing this. I will be talking about that at the end of the video, but for right now, I want to focus on the gold price alone. So we are seeing gold rising in this steep and expanding rising megaphone pattern here. Let's zoom it in one level and just have a clearer view on this. So you can see really clearly here, notice the multiple hits along this lower trend. And notice something of an expanding boundary here. We're drawing a double blue line, but notice every time the price, notice from all the way back here in 2018, every time the price gets up to this band, it gets rejected in one way or another. You know, slight overshoots here, slight undershoots, but every time we get up to this blue upper resistance band, you get rejections, right? Every single time. So there are sellers that are showing up here. They are taking their profits at higher and higher levels. That is still a bullish trend. Let's not mince words. But they are showing up. And so the question is, I want to actually go back one level here and remember that we are approaching this 1800 level, which if you ask me and you go all the way back to 2011 and notice that the absolute peak in gold above 1900 per ounce, this was only exceeded for a couple weeks, and then gold collapsed back below that 1900 level. Notice where a lot of the retests came up to. One at 1800, two tests at 1800, three tests at 1800, and then it failed, right? So I'm going to argue that 1800 is actually the more relevant resistance level than the all-time high, which is 1923 US dollars per ounce. So let's go and zoom back in. Now remember that black line. So we're getting close to that 1800 level. This is major resistance coming up. And ladies and gentlemen, trust me, 1800 is not going to be broken on a highest probability basis the very first time. We saw it was rejected 3 times back in 2011 and 2012. Sellers will be showing up there again. And so that's why I'm not worried about chasing this move right now. What I want to do is zoom in even closer. We are bumping against this upper resistance boundary. I want to zoom in even closer and just show you the short-term pattern that's developing here. From the recent crash lows, the coronavirus crash lows, just above 1450, almost a $300 rise. Broken trend here shown in turquoise, and now what? We're forming this type of a pattern, which is, of course, a pennant triangle. And so we have the pennant triangle forming. The pennant triangle is a neutral pattern, but it takes its bias from the preceding movement. In this case, the preceding movement was higher. We have a neutral pattern. We should expect a bias higher for this pattern. Let's remember the context, though. We're approaching that 1800 resistance. Now, there is a way to calculate a target for a pennant triangle, and that is to take the amplitude of the triangle, which is 87, from the highest point to the lowest point of the triangle, $87, and that amplitude is added onto the apex of the triangle. You have buying, selling, buying, selling, buying, selling, and all these individuals, they are wearing themselves out as this pennant works its way toward the apex. This is what's happening in fundamental terms. It's buying and selling, and these participants are wearing themselves out. And the bias is that there is going to be another surge of buying that comes in here at some point in the later part of May. And this will give us a target of 87 added on to the 1703 breakout, which gives a $1,790 target. So remember that number, 1790. When we go back to the big picture view, look at how close that independently arrived short-term target gets us to this 1800 major black resistance zone going all the way back to 2011. So when we have a short-term target that coincides with a long-term resistance zone, this very much increases the odds that we will hit this zone, that the pattern will resolve higher. But then notice what happened to gold every time that it got to 1800 going back 8-9 years ago. These types of patterns, these types of cup patterns here often like to feature a form of symmetry. And so from a highest probability basis, I strongly believe that although this pattern should resolve higher, there will be a significant retracement once we get back to the 1800 level. We'll be looking at support coming in here to the mid 1500s. Very clear support here, the broken peak here dating back to 2019. This should act as support. Some of these lows in here from 2019 as well should be acting as support, which will match with this lower rising boundary. We must not forget about these lower rising boundaries. Even when the price has been very aggressive on the upper boundary, we should never forget about this. So it looks like gold is wanting to set up something of a symmetrical cupping pattern here that will be something like a 10-year cupping pattern. And I would argue that if you own no gold whatsoever at this point, you should be doing some buying in here in case this is the one time that gold is just going to blast off to the moon. You should have some gold, but the key word is going to be some. Because from a highest probability assessment, this market should be encountering significant resistance here at 1800 and should have a nice 6 to 9 month correction here into the later part of 2020, into 2021. And if I was to hypothesize about what the fundamental trigger for a correction like this will be, it will probably be another round of deflation, similar to what we saw here due to the coronavirus. Who knows what these insane central banks or world governments are going to try to do, whether it's nefarious, whether it's benign. We can have that debate when we observe what happens, but there's certainly going to be some further interest in shutting down world economies here later on this year, especially if we get another surge in the coronavirus. And so this, I believe, will be causing that deflationary retracement. Gold will get caught in that deflationary spiral as it did last time, and then gold should respond better than most asset classes in clawing its way above that former point where the deflation began. And so we will be looking at the possibility of gold finally breaking out above its all-time high in US dollars at some point within the next 12 to 18 months. It will not happen the first time, and there should be significantly lower buying opportunities before we get to that legitimate breakout here in gold that is coming according to this analysis. I do want to tell you about that Dow to gold ratio. Before I do that, I want to tell you about the premium research service. If you like this kind of analysis, you owe it to yourself to check out our premium service, Precious Metals Intelligence. We do analysis like this not only on gold, but on silver, the US dollar, the US stock market. And by the way, coming up within the next few weeks, we are going to be initiating short positions against the US stock market because I believe it is going to be falling significantly over the 6 to 18 months ahead. And you could say, well, you'd rather buy gold than short the stock market. Fine. I'm saying it's not either or. I think there's going to be a merit to doing both. And we will be sending out the exact buy and sell signals that we give for the stock market here coming up over the next couple of weeks and several months. And this signal that I was talking about, this major new signal, is going to be the focus of the premium update coming out on Monday morning. This Dow to gold ratio signal. We have not seen this signal since the 1970s. What we are looking at right now, we will be talking about this extensively coming up in the premium update. If you sign up for a year of Precious Metals Intelligence, you are entitled to a free consultation for 30 minutes. If you do not want to sign up and you simply want to speak to me, Christopher Aaron, someone who tries to approach these markets from a logic and a data-based standpoint, and it is an exciting time. These are exciting markets. There will be significant opportunities, but I say let's try to approach it from as rational a standpoint as possible. If you would like to speak to me one-on-one, please know you can reach me on the Consultations tab, and I take no fees from any of the funds, whether we're shorting the stock market, whether we're going long gold or some of the gold miners. I work simply for the best interest of individuals, so I want to let you know that. If you would like to follow the free videos only, make sure to hit the big red subscribe button, because the Dow to gold ratio is showing that the Dow is set to fall significantly over the intermediate term. Doesn't have to be today. It doesn't have to be tomorrow. I am not saying that. But over the intermediate term, the next 6 to 18 months, it strongly looks like a major correction is in store, and I don't think very many people are considering this possibility. You know, if you ask me, most people who study the stock market, they only study the last 10 years. We've been looking at some analysis that this market, last week in this video, we looked at the comparison to 1929. And so this comparison is leading us to strongly favor initiating some short positions on the stock market itself. Make sure to hit subscribe. And if you appreciate these videos and you want to leave a little something in the tip jar, I very much appreciate that from you. There's a link to the Patreon site below. Super exciting time here, guys, but let's try to stay as focused on the actual data as possible. And when we look at that resistance zone at 1800 for gold, that is going to be formidable. We have a short-term pattern that indicates that it's going to try to hit that 1800 here within the next few weeks, likely by the end of May, early June. But I would not be willing to wager that it's going to blast through 1800 on the first try. And so I think the prudent precious metals investor is going to wait for a pullback to form at this point later on in 2020. Let's watch for that and a lot more. Thank you for being here. Please stay safe, stay healthy, stay strong.